Welcome to the Income Tax Training. In Australia, our financial year runs from the 1st of July to the 30th of June. Tax returns are due by the 31st of October, though registered tax agents can usually secure extensions. We operate under a self-assessment system. This means the ATO accepts the information on a return without immediate scrutiny, placing the legal onus entirely on the taxpayer to ensure accuracy. Because of this, taxpayers must retain their records in English for a minimum of 5 years. The ATO generally has 2 years to review and amend a standard individual assessment, but this extends to 4 years for complex businesses and becomes unlimited in cases of fraud or evasion. Who actually needs to lodge a return? The golden rule is that most residents earning over the $18,200 tax-free threshold must lodge. However, there are critical exceptions where a return is mandatory regardless of income. If a client had any tax withheld, paid PAYG installments, or has reportable fringe benefits, RFBA, or reportable employer super contributions, RESC, on their income statement, they must lodge. Furthermore, carrying on a business, holding an ABN, claiming tax losses, or navigating specific child support liabilities also trigger a mandatory lodgement. Understanding what constitutes income is the foundation of tax preparation. We categorize income into 4 classes. First is assessable income, which you use to calculate tax. This includes ordinary income, like salary and interest, and statutory income, like dividends and capital gains. Second is exempt income. While not taxed, it can reduce tax losses and impact government income tests. An example is a disability support pension for someone under pension age. Third is NAIN income, which is legally treated as if it were never income, like specific disaster recovery allowances. Finally, non-assessable amounts include personal gifts, hobby income, or standard lottery wins. Australia's pay-as-you-go, or PAYG, system ensures tax is collected throughout the year via withholding from wages, or installments for business and investment income. A major shift in recent years is single-touch payroll, or STP. Employers now report payroll data to the ATO every single pay period. As a tax preparer, you must ensure the client's income statement is marked as tax-ready before lodging, meaning the employer has finalized the data. STP Phase 2, which launched in 2022, provides us with highly detailed, disaggregated data. Instead of one lump sum, you will see gross amounts separated from paid leave, overtime, bonuses, and specifically itemized allowances. Moving to the tax return itself, Item 1 covers gross salary and wages. This includes standard pay, commissions, bonuses, and paid parental leave. You must accurately assign a 6-digit occupation code here, as the ATO uses this to benchmark your client's deductions against peers. Item 2 deals with allowances. Under STP Phase 2, allowances for travel, laundry, tools, and overtime meals are broken out distinctly. It is crucial to distinguish between an allowance and a reimbursement. A reimbursement is an exact compensation for an incurred expense backed by a receipt. It is not assessable, but the client cannot claim a deduction for it. An allowance is an estimated, predetermined payment. It is assessable, but the client can claim valid deductions against it. Employers sometimes pay out lump sums on termination or for back pay. These have specific tax concessions. Lump Sum A covers older leave accruals, pre-August 1993, or leave paid out due to a genuine redundancy. It's capped at a maximum 30% tax rate. Lump Sum B is for very old leave accrued before August 1978. Only 5% of this is actually assessable. If a client is made genuinely redundant, the tax-free portion of their payout appears as Lump Sum D, which is NAIN income and completely ignored for tax. Finally, Lump Sum E represents back pay older than 12 months, triggering a special tax offset so the client isn't unfairly penalized for receiving it all in 1 year. The income test section of the return doesn't change taxable income, but it radically impacts offsets, Medicare levy surcharges, and government benefits. Let's look at fringe benefits. When an employee's salary sacrifices for a non-cash benefit, the employer usually pays FBT at 47%. While the employee doesn't pay income tax on the benefit, if the value exceeds $2,000, the grossed-up value is reported as a reportable fringe benefits amount, RFBA, at item IT1. Similarly, if an employee's salary sacrifices into super above the 11.5% mandatory guarantee, it is logged as a reportable employer super contribution, RESC, at item IT2. Government payments can be tricky. Some are fully taxable, some are exempt. Taxable allowances like JobSeeker or Austudy go to item 5. Taxable pensions, like the age pension, go to item 6. A major one to watch for is paid parental leave. For 2025, eligible parents can receive up to 22 weeks of pay. Because this acts as employment income, it is fully assessable and must be declared at item 1, not as a government allowance. Even if a client receives an exempt pension, like a disability support pension while under age, it must still be declared at item IT3 for income test purposes. Investment income relies heavily on the concept of constructive receipt. For interest, it is assessable the moment it is credited to an account, even if it's locked in a term deposit that hasn't matured yet. For joint accounts, the ATO assumes a 50-50 split unless documentary evidence proves unequal ownership. Dividends represent a share of company profits. Because the company has already paid tax, the client receives a franking credit. We must declare both the physical dividend and the franking credit as gross income. The franking credit is then applied as a tax offset. Remember, dividend reinvestment schemes are still fully taxable as constructive receipt. Residency dictates how an individual is taxed. Residents pay tax on worldwide income, while foreign residents pay only on Australian-sourced income. To be an Australian tax resident, you only need to pass one of 4 tests. The primary test is the resides test, looking at physical presence, family ties, assets, and behavior to see if someone actually lives here. If they fail that, we look at the domicile test, is their permanent home Australia, and have they been overseas for less than 2 years? The third is the 183-day test. Have they been physically present for more than half the year without a usual home abroad? Finally, the superannuation test covers Commonwealth government employees posted overseas. Finally, calculating the tax. For Australian residents, the first $18,200 is tax-free. After that, progressive rates apply, 16% up to $45,000, 30% up to $135,000, 37% up to $190,000, and 45% on anything above that. If a client changes residency partway through the year, their tax-free threshold is prorated based on the months they were resident. Foreign residents do not get a tax-free threshold, they start paying 30% from $1. Working holiday makers on 417 or 462 visas have a special rate, 15% on their first $45,000. However, if they are from a non-discrimination article country, like the UK, Germany, or Japan, and established tax residency, they are taxed at normal resident rates and can claim the tax-free threshold. This concludes the core breakdown of Part 1 of the Income Tax Guide.